Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on markets and economic events. Let's get started. First of all, let me apologize to everyone who's been looking for a new Market Insights all summer long. We took the summer off so that we could focus on completing our latest software release, which we are pulling into the finish line even as we speak, and that's why you get a new Market Insights. Now, this Market Insights is going to be devoted to a topic that seems to be beaten to death in the media, and we've covered it a lot in prior strategic insights and market insights. But since the Federal Reserve has just made a major policy statement at Jackson Hole, I think we have to bring back the old topic of inflation. So, first of all, we have beaten this subject to death in prior market insights. Please check them out on our website, caravelconcepts.com, if you want us to go in depth on what we believe created the inflation problem. But in a nutshell, we believe inflation is too much money chasing too few goods, and money supply in 2020 and 2021 hit 25% annual growth. That is almost twice the worst that we saw in the 70s, and is it any surprise that we have now inflation, especially when you combine it with the too few goods caused by COVID shortages and then the invasion by Russia of Ukraine, which took a major supplier of wheat and corn and soybeans, Ukraine, out of the global markets, and it took the number 2 or 3, depending upon the month of the year, the number 2 or 3 oil producer, Russia, out of global energy markets. All of this, too few goods, too much money. We've covered it extensively. The problem is that that's what I believe, that's what a lot of people believe. It is not what Fed Chairman Powell believes. As he made crystal clear in his Jackson Hole speech, and as he made crystal clear in earlier testimony before Congress, he doesn't believe, and I believe this is almost a direct quote, that money supply is a reliable gauge of future inflation. He doesn't believe in any of that too much money, too few goods stuff that I just talked about. Now, why not? Well, believe it, the last few years of unbelievable money printing has been accompanied by unbelievable money supply growth. But if you go back to 2008, 2009, 2010, all the way to 2013, the Federal Reserve printed a lot of money and we didn't have inflation. So Fed Chairman Powell is saying, oh yeah, we printed a ton of money, but so what? We printed a ton of money back in 2008 to 2013. One time we got inflation, one time we didn't. Money supply is not a reliable gauge. But wait a minute. Money supply did not grow from 2008 to 13 at anything like, it was like 7% through that entire period. Right? Money supply hit 25%. So something was different from 2008, 2013, and the last couple of years. And we think it's pretty obvious what it is. The 2008 to 2013, there are 2 money printing machines in the U.S. economy. There's the Federal Reserve, and we did a video on this where we talked about how the Federal Reserve gets to decide how much money's in their checking account. When they want to print money, they go poof, there's more money in our checking account, and they go out and spend it. All right, but there's another money printing machine in the U.S. economy, and that's the private sector banks. The private sector banks don't get to decide how much money is in their checking account, but they get to decide how much money is in your checking account. When they make you a loan, you sign a piece of paper and they go, poof, there is more money in your checking account now. And you can go buy a truck or a car or whatever it is that you're looking to buy with the money that you borrowed from the bank. The banks actually get to print money too every time they make a loan. All right? From 2008 to 2013, if you recall, the banking system was in crisis. We had all these mortgages that had gone bad. Banks were not making new loans, they were foreclosing on old loans. And so they were dramatically unprinting money. So for every dollar the Fed printed, the private sector banks unprinted, and net money supply growth wasn't very high. Fast forward to 2020, 2021, the Federal Reserve's printing a ton of money, but this time the banking system's in really good shape. They're recapitalized, they're making money. And more importantly, if you want to get a bank really excited about making loans and therefore printing more money, have the government guarantee those loans, as the government did in 2020 and 2021 through the PPP program. Banks get really excited about earning interest on a risk-free loan because the government is going to make sure that you pay them back. And so money supply exploded because both the Fed and the private sector banks were printing tons of money. Now, that's my very easy explanation for the two different reactions in money supply when the Fed printed money in 2008 to 13 and in 2020 and 2021. But my opinion doesn't count. Fed Chairman Powell's opinion counts. And what he believes is that money supply, I'm not even going to look at it. Don't care that money supply is shrinking now. It doesn't have anything to do with future inflation. The problem with inflation has been caused because Americans are buying too much stuff, and because unemployment is too low, and companies are having to pay higher and higher prices to attract workers, and that means they've got to pass along those costs to their customers. This is what's called the cost push model of inflation. It's kind of the opposite. I'm a monetarist. This is the cost push model. Powell, cost push guy. And that means he is determined to raise interest rates until a lot of people get fired, until a lot of Americans decide that they're not going to buy any more stuff, until the economy is pushed into a recession. And that will cure, according to this model, that will cure the inflationary pressures. And Fed Chairman Powell's been very disappointed that the economy has not reacted to what he's done so far by slowing very much. And not many people have lost their jobs because corporate America just went through 2 years where they couldn't find enough workers. So even though they see sales falling, even though they see the economy slowing, they're not laying off very many people like they usually have for basically my entire life. Instead, they're trying to hang on to people because they've just been reminded that workers are an important asset of their company. And so what that means is that Fed Chairman Powell, he wants to see people fired. I mean, not emotionally, but I mean, to cure inflation, he thinks that's what has to happen. People have to get fired and the economy has to slow dramatically. And since that's not happening the way that it normally has for the last 50 years, companies would fire people first and ask questions later. They're not doing that right now because of their experience of how painful and costly it is not to be able to attract great workers. Companies are resisting the impulse to fire, which means that the Fed chairman says, I got to raise interest rates even more, and even more, and even more. And that makes it all the more likely that we go into a recession. And that's what the market is now getting its head around. That's what investors are having. We saw a 1,000-point drop in the Dow on Friday, and we're seeing more drops this week. And that is all, in my opinion, because the market now gets it. All the good news that we got on inflation for the last several months, Fed doesn't care. Until they see unemployment going up, until they see the economy seriously slowing, they're going to keep raising interest rates. And that means that we have more belt tightening ahead for corporate earnings. We have more rough times that are likely to be imposed upon us by the Federal Reserve. And markets are now repricing for that new reality. The answer is, well, one, we did try that in the 70s. Richard Nixon did impose oil price caps. And a funny thing happened. Oil prices and gas prices at the pump absolutely were capped. But you got a great price on gasoline that you couldn't buy because there were massive shortages of gasoline. Because guess what? The price of oil and the price of gasoline is not determined by the American people. Even though we're number one oil producer, we produce maybe 30-35% of the world's oil. That means that 2/3 of it is produced elsewhere. And oil is traded and wheat is traded in a global market. So if that oil producer in Houston may say, I'm a patriotic American, but if he can get an extra $10 a barrel for oil in China, he's selling that oil in China. Because oil, it's very easy to move oil, it's very easy to move wheat anywhere in the world where you can get a better price. And so essentially the price for oil is not set in the United States. It is set in the global marketplace. And American producers have very little control over what that price may be, because that price is going to be set based upon what is demand and what is supply in the global marketplace. So, for example, right now, for the last several months, we've enjoyed falling oil prices. Why? Because one, the US production keeps increasing, but two, and far more important, the higher price of oil has caused oil consumption to collapse globally. And so with less demand, the same amount of supply is commanding a lower price. But it wasn't American consumers alone who stopped driving. It was consumers in Europe and Africa and India and China. Everybody reacted to higher oil prices by driving less and trying to conserve, and that forced the prices back down. With the the same thing happens in wheat markets, in soybean markets. And the problem is not only did Russia invade one of the largest wheat producers in the world, Ukraine, you also have had horrific droughts in the United States, the grain basket in the Midwest. You've had horrible droughts in India. You've had floods in Pakistan. Those are major grain producing parts of the world. And so when those supplies don't come from these major producers in Ukraine and India and so forth, there's nothing that the US can do to stop grain prices and therefore bread and all the foods from going up for US consumers. If they tried to impose a price cap the way that you're suggesting, then all of those farmers in Kansas would just sell their wheat to India where the price is higher. Thanks for joining us for Market Insights. We hope you found it informative. If you did, could you like the video and share it with your friends? If you'd like to see more of our research, you can check out our website, caravelconcepts.com. Thanks.